Right, lads and ladies, today we are running through market structure. What is market structure? Market structure is the way the market moves. Market structure refers to the arrangement of price movements over time, which forms the bias for analyzing trends and predicting future price action. Understanding market structure helps traders identify potential entries and exit positions, manage risks, and build solid trading strategies. When you know what, this is all going to be in the course, and I'll leave the link down below. I'm just going to wing it though and just show you because it's better than reading. It's easier to understand when you see it. So the market is made of highs and lows. So a high in the market is an up move and then a down move. That's your high in the market. Make it a little bigger. Your high in the market is an up move and then a down move. And then your low in the market is a down move and then an up move. So it's pretty much a two candle formation. It's a high and a low. That's it. So if we look at this candle here, we have two candles. This right here is going to be our high of the two candles, and this right here is going to be our low of the two candles. Just so happens that this seems to be in one candle. That's a high and that's a low of the thing. And if we look at here, we have two candles here, two consecutive candles, a down candle followed by an up candle. So there is your low, down candle, up candle. This is going to be your lowest point. And then if you have a high, you have an up candle and a down candle. The high of the two, down candle and an up candle, the low of the two, and vice versa. So now, if we get rid of these, we know what highs and we know what lows are in the market. So now, another very key, another important thing we need to know is a swing high and a swing low. So a swing high is just a high where the wicks or the candles on both sides of the high, the one in the middle, are lower than the one in the middle. So that causes a swing high. Where's my yoke? That causes a swing high. There you go. And then your swing low then will be the opposite, down. And then this one's going to be lower than this. And then this is going to be your swing low down there. Now, let's have a little look for a few swing highs and swing lows. So we have a swing low here. Why is it a swing low? Because we have the low of this candle is lower than the two candles that precede it to the side. Here's another swing low. Swing lows are great levels for liquidity and liquidity sweeps. So you'll see highs and lows in the market all the time. And technically they are liquidity, but you would look at a swing high and a swing low as a much higher level of confluence of liquidity or for whatever you may be trading. So you have your swing low. Is this a swing low? If we were looking at this red candle and this red candle and this green candle, is this a swing low? No. Why? Because this one is lower than is lower than this one. So there's no swing there. There's no hoop. Although this would be a swing low if you took it into consideration with this candle. There's your swing high. You have your high. This high is bigger than the one to the left of it, and it's also bigger than the one to the right of it. The swing highs and lows are more valuable pieces of confluence when you're taking a trade or looking for liquidity or look at the target levels of liquidity or whatever it may be. So now, if we look at market structure, we have three types of market structure. We have bullish trend, we have bearish trend, and we have consolidating. You can call it ranging as well if you want to. Ranging. So you can have your bullish, your bearish, and your consolidating. That's all the market will ever do. It's either going up, it's going down, or it's going to the side. It's never going to be doing anything else. So how do we identify what sort of trend are we in? Bear with me, sorry. How do we identify what trend we're in? So a bullish trend is always going to be identified by higher highs and higher lows. Higher high, higher low. Higher high, higher low, higher high, And then your bearish trend is always going to be a lower high, a lower low. Well, that was your lower high, and then your lower high, and then your lower low, lower high, lower low, lower high, and so on. Right, now let's have a look. Let's just label these up real quick. So you have your higher high, then you have your higher low, and then you have your lower high, then you have your lower low. So now, okay, this is your higher low because it's higher than this one. This is a higher low because it's higher than this one, and so on. So this is your high, and then price come down and makes a higher low. Why is it a higher low? Simple. It's very easy. It's simple because this low is higher than this low. Simple as that. And then price comes up, we break past this high, so that means that the next high is higher than the previous one. Same with your higher low. This low is higher than this one, so it's your higher low, higher high, higher low, higher high, higher low, and so be it. Now, if we're in a bearish trend, we have a lower high and we have a lower low. Nope. Have a lower high and you have a lower low. So this is going to be your lower low. Why? Because it's lower than the previous low. This is going to be your lower high. Why? Because it's lower than your previous high. It's very simple stuff. Lower high because it's lower than this one. Fuck up, man. This is going to be your lower low. Why? Simply put, because it's lower than this one. And then you can keep going on. Pretty self-explanatory. Fine. These are these are two of the three that you're going to see. You're either looking for when you come onto the charts and you see the price making higher highs and higher lows, that means that you're going to be looking for buy positions. Why? Because that's the way the market is trending. So you're going to be looking for buy positions. And then if you're looking, the trend is your friend is always a good sign. The trend is your friend, and there's no point trading against the trend because you're going to lose. If you don't lose, it can be very, lucrative, but it's just easier to go with the trend. See, and I'll tell you why it's easier to go with the trend. But first, take a little screenshot of this and understand it first. So you have your higher high, higher lows with your bullish trend, and your lower highs and lower lows with your bearish trend. Right. What was I going to say? Short position. What was I going to say? Terrible. Yeah, sorry. You want to get into the trends of your friends. There's no point in you get rid of all this now for a second. If you know the price is making consecutive higher highs, that's a bad example. If you know price is making consecutive higher highs and higher lows, well, then that means that you know price is in a bullish trend, right? So why would you look to sell in a bullish trend? The only way we could sell in a bullish trend is if you wanted to catch this little move. This little move is what we call a retracement. These big moves is what we call an extension. So the big move here, this is your extension, and the little move is your retracement. Just label that up here. Why would you want to take this little sell when you could simply just wait for the sell to happen and then get in and enter yourself into a better buying position to take advantage of this whole move up or this whole move up? When we're in a bullish trend, your retracements or your corrections are always going to be smaller than your extensions, because if they weren't, you would be in a bullish trend. And then vice versa, then in a bearish, if we just do that, well, that invert, that's bleeding beautiful, isn't it? That saves a lot of hassle. Then your retracement in a bearish scenario, which means we're going down the way, so we're looking for sales. Why? Because the trend is our friend. We know that if the overall bias is down, the overall bias is bearish. There's no point in us looking for bias, because the bias that we get, we're only going to have to be in and out of them, because you're in a bearish trend overall. You want to take advantage of this extension. You don't want to be caught in the retracement. So now, Let's have a quick look at. Let's flip this chart back around first. Does that flip back around? Now let's have a look at range of markets. So if you know higher highs and higher lows, that's going to be your bullish trend. Lower highs and lower lows, they're going to be a bearish trend. What do we do when price is doing something like this? Consolidating. Price is simply just going left to right, just going sideways. Stay away from the markets. I do, a lot of people do. It's just easier because there's so little. Price isn't going up. There's no clean. Right, well, prices at the going up, we're at the retrace, and then we have an extension and a retracement, and there's no extension, there's no retracement. So what are you trying to profit off? Do you know what I mean? What sort of move are you trying to make money off? Is it going up or is it going down? Or it doesn't make any sense. There's no overall bias for a structure. There's no structure there. So I personally just stay away from the market. But in consolidation or consolidating ranges, it's important to know, just make this a little bit cleaner so you can see it properly. It's important to note that a consolidating range is always good for generating liquidity. Why? Because at the top, if you're buying and you're selling, you're always going to have your stops above. If you're selling, you're going to have your stops above all highs. So if you're selling, you're going to have your stop up here. And if you're buying, you're going to have your stop down here. Why? Because that's how you're taught. If you're in a range market and price is going up, you're going to put your stop beneath the previous low, or you're going to put it above the previous high. That's what everybody's taught. But if that's what everybody's taught and 95% of traders fail, well, then they're all doing the same thing. They're all going on to Facebook or YouTube or whatever it may be, TikTok or something, same way you are here now. And they're all looking at the same thing. And they're all doing the same thing. They're all putting their stop losses in the same place. So that makes price really predictable. So if we know that price is, say, for example, consolidating between these two ranges, right? Now stick with me here now. And if you don't understand, as always, ask the question like the snow has. So this is your support zone, so to speak. And then say, for example, this would be what's called a resistance zone. People look at them like floors and ceilings, and the way they'll trade is they'll say, right, well, price can't break through this floor here now. So we're going to get a reaction off it, so we're going to price a buy. And then you have the sellers that are thinking the same thing in the opposite direction. Price isn't going to break through here now, so we're going to sell. Buy, sell, buy, sell, buy, sell. What's this doing? What's everybody doing up here? What's down here? Liquidity. If you're buying up here, liquidity, 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 liquidity. It's just generating liquidity. Whether you know it, whether you don't know it, especially retail traders, they don't know it. There's so much liquidity up here and there's so much liquidity down here that in a ranging market, you would rather just wait for price to break, sweep for some form of liquidity, top, bottom, whatever it may be, and then reverse in the opposite direction. Or if it doesn't do that, you may just get a little bang and then bang and then bang. It doesn't necessarily have to take out these lows and then just go high. It might take out these lows and then take out these highs and then come back down. Why? Because when it does that, the thing behind traders are, say for example, we're in a buy position here. That's a sell position. Whoa, is that a sell position? Is this chart still inverted? This chart is still inverted. Oh, for fuck's sake. Right, now, let's say, for example, you're in a buy position here. And your stop loss is whatever, somewhere down here, right? And now let's say you're in a sell position. Your stop loss is somewhere around the same and you're targeting whatever it may be down here, yeah? Institutions see that. I see that. Well-informed traders see that. We see this. You see this happening on a chart, and this is what we see. Do you get me? Always understand. So what do traders do? What do institutions do? They let this, the longer this is like this, the more liquidity that's generating, which means there's going to be more orders. Remember, we were talking about in a different video that in order for an institution to sell 150 million, there has to be of lots. I mean, it has to be somebody to buy those 150 million, or in order for them to buy 150 million, there has to be 150 million of sell orders in the market for them to buy. So how do they do that? Bang, generate liquidity. But see, in ranger markets like this, what they'll do is they'll drive price down. bang, these buyers are about to get swept out. What will they do? You'll have what's called then a breakout trader. So breakout trader, these boys here, they're gone. They're at the getting stopped out. But then you have a breakout trader as well. So what's a breakout trader going to do? A breakout trader is going to see this breakout. They're going to say, oh, well, this is going to be the move. And I'm going to put we stop now somewhere, whatever the high or something is there, because that's what they're trying to do. I'm going to put me stop somewhere below above the high, and I'm going to target whatever form of liquidity may be sitting down there. Breakout trade is what we call this. So you get a breakout, bang, and they just enter straight out the breakout, and then they're gone. They're gone. And then what happens? Price continues up, and then they're gone. Bang, you're gone. Bang, you're gone. And then price, say for example, then what price will do is it will make its intended direction. You're out to getting swept. You're out to getting swept. You're out to getting swept. These boys are out to getting in at the best price possible. All of this liquidity is all here for them, and they're out to making the massive move. This is the move that they're out to catching. So tell me this: would you rather catch this smelly little move in here, up, down, up, down, up, down, up, down, up, down, making 10 trades during this session, or would you rather just wait for a breakout, wait for some sort of confluence, and then catch the big move, enter the one trade, and get it all done, boxed off in the one move, instead of being trapped out here and trapped out here? Because there's nothing worse if you are a seller. There's nothing worse than when you are selling up here and price does come and sweep your stop loss, and you were right. You were right in your directional analysis, but you still paid the price because you didn't wait. You tried to be greedy with it. That's the idea behind consolidation. That's the idea behind market structure. Now, there's a lot in market structure, so I want to make sure that I cover everything. When we talk about market structure, you hear a couple of different things being mentioned. So what you have breaker structure, you have market structure shift. What else have you got? Delete those jokes. Market structure shift. You have your CH OC. You change your character. What else have you got? Hold on here now. Let me find out. I don't want to leave anything out. Uptrend, higher highs and higher lows, lower highs, lower lows, bearish, power time frames. We'll go into that now in a minute. Actually, markets are fractal. Fine. Swing low. No. I think that might be it. No, there's definitely more. Come to me. Right, so let's start out with a breaking structure. Breaking structure, simply put, it simply is just a breaking structure. In a bullish trend, we're making, actually now, hold on, let's invert the screen back again. Right, that's more like it. A break of structure is simply when price is making higher highs and higher lows. Handy. That's your bullish trend, and then we have a bearish trend. Your break of structure is when price breaks past the previous high and creates a new high. So this here is your break of do I have break of structure? Your break of structure, and then you have on the way down, this is going to be a break of structure. No, this is going to be a break of structure. Why is this your break of structure? Simply put, it's a continuation thing. So break of structure and market structure shift, they're used interchangeably. They're used interchangeably. They're the same thing, and a lot of traders look at them like they're the same thing, but they're not. They're not the same thing, because a market structure is when price does something like this. We go bang, bang, bang. Now you can use them. It's not the biggest thing in the world. Like if you're pointing it out on the screen, people know what you're talking about. But just to build up that confidence in your brain that you know what you're talking about yourself, it's just good to understand what the difference is between them. And relative equal highs and lows we need to go into actually. So Why is it this is break of structure? Because it's the continuation of the trend. Simply put, if you're taking notes, if break of structure is your continuation of the trend, and your market structure shift is your reversal of a trend. So your break of structure is when we break past. If you're in a bullish scenario, you're going higher highs, higher lows. Every time we break past a higher high, excuse me, that's your break of structure. Break of structure when you break past a previous high. Break of structure, bang, retracement, handy. Why is this not a market structure shift? Because we haven't shifted below this low. So we have your higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then this higher low has now been broken. So we're at the breaking structure, or you're at the giving yourself. Well, you're not at the giving yourself, but I'm at the giving ourselves a market structure shift. So it's not a break of structure now because we aren't continuing with the trend. We aren't continuing to go up and down and up and down. We're just at the going up, and then we failed to just get a retracement and we broke past, and that's your market structure shift. That's a sign that sellers are gaining back control, and there's more sellers in the market than there previously was. Why? Because instead of buyers coming in midway through the zone, buyers now can't hold the midway through the zone anymore. So sellers are more in control. They're driving the price down lower here, and that will give you a sign of weakness essentially. And then it's the same thing over here, vice versa. Actually, can I just get rid of this and then just invert the screen again? I wonder. That's so handy. Look, lower high, sorry, lower low, lower high. Why? Because this high is lower than this one. Lower low. Why is it a lower low? Because this low is lower than this one. Continue down, lower high, lower low. Perfect. This is going to be another break of structure. That's a break of structure. Break of structure. Why is this not a break of structure? Because we broke past our previous. This would be your lower high. Let's just mark this out. Yeah. For your low. This is going to be your lower high. This is going to be your higher low. No, this is going to be your lower low. Lower low, lower high, lower low, lower low, lower low, lower high, lower low. Happy days. And then we broke past this lower high, and that's your market structure shift. So now we know what our market structure shift is. I'm going to do up a chart at the end and include everything in it, but I just want to sketch through everything first, just so you have an understanding of it. So let's go back to our screen. Now, what's a change of character? So change of character is your first sign of weakness if a trend reversing. Higher high, higher low, higher high, higher low, higher high, higher low. Happy days. Lower high, lower low, and then the trend may do whatever it wants to do after, but that's not important. What's important is this move right here. See this here? That's a change of character, we call that. Why is it a change of character? Because instead of price continuing to go up, we went up and then we couldn't break past this high anymore, which tells us that one, sellers are gaining back momentum, or else buyers are losing momentum. So we couldn't break past this high, so we can't continue this uptrend. So what does price do? Comes back. Sorry, change of character. Market structure shift. So your change of character would kind of be your first indication, and then your market structure shift would kind of be your second indication. And then once you get the two indications, you can kind of safely say that on this time frame or on the lower time frame, whatever you're looking at, that the trend is reversing to possibly continue to come down the way and start making lower highs and lower lows. Now we have what we call fractality fractal. We go into fractality now in a second. Where was it? It was, I think it's don't even open, man. Don't even open. Fuck's sake. Start closing this. Equal highs and equal lows is what it was. An equal high in the market is when this high is the same as this one, and then price goes up and does its thing. These act as a very strong draw on liquidity. Boy, can I copy that, you reckon? Not even gonna try it. Bang. No. Bang, 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 bang. These two are your equal lows, or your relative. They don't have to be bang on the money, as long as it didn't sweep the high, though. As long as it didn't sweep it, because if it swept it, but then you look at it like as a liquidity sweep and not as a equal high or an equal low. So these are your relative equal lows, and then these up here are going to be your relative equal highs. Bang, relative equal highs, relative equal lows. Happy days. Why do these act as such a strong level of liquidity? Because if you're selling at this stage anyway, in this scenario, you're going to have your stops above this high. Everybody does. That's just the way traders are wired. Now the issue with that is these equal highs mean that people who are selling from this zone, they have their stops above this high, and people who waited and they got in here, they have their stops above that high as well. So that just shows us that there's more liquidity, if anything, resting above here, and there's more liquidity, if anything, resting below here. Why? Because vice versa, if you're buying from this first leg up, targeting whatever it may be, stop below the most recent low, happy days. Price comes back down, same thing again. That means the people who bought from this zone and the people who bought from this zone, they're all going to have the liquidity, their stop losses down here. So it just makes it a good draw on liquidity. So you ever see equal highs or equal lows in the market, they're bringing draws for liquidity to come back to. And that's kind of the reason behind them. I'm trying to think now, is there anything else? Find out. Equal highs, equal lows, liquidity sweep, market structure shift, X, S&T. S&T is its own video, and then X just your liquidity. What was that one actually? Liquidity sweeps. It's very important as well that you understand liquidity sweeps, because like we said, if we had say for example you have a double top or relatively equal highs, they're called. So if you have this, for example, that's called a double top, but it's also a relative equal high. They're the same thing. Now if price comes up and goes bang bang, creates a high and then beats this by a couple pips and then comes back down, is that still a relative equal high, or is that still an equal high? No, that's a liquidity sweep. What is a liquidity sweep? That is, depends on where you look at it, institutional traders sweeping your liquidity in order so they can get into the market at a better position, one, or so they can take your liquidity and then drive price, fill their orders, their bigger orders, and then drive price in the intended direction, which is, there's nothing worse. Well, it's a kind of a double-edged sword. There's nothing worse when you're in a position and your positioning is correct, your directional analysis is correct, but you still lose the trade because you get stopped out, because you get stop hunted. There's nothing worse than that, let me tell you. Let's do a quick drawing here together, just so you can do it in your notes. And we try to incorporate everything. Right, so we have higher high, higher low, higher high, higher low, higher high, higher low. And then let's go very big high here. And then we're going to go bang. And then we're going to go bang. And then we're going to go bang. We're going to go lower high, lower low. Start working your way back down. Now, you have your higher highs. You have your higher lows. bear with me 2 moments. Lower highs, so we know finally now, just before we wrap up, you have your higher high, and then you have this is also a higher high because it's higher than that one. Pretty self-explanatory. That's higher than that one, so that's your higher high. There you go. Do you know what would make that actually? Can we do that? I don't think so. I won't actually. And then you have your higher low. Why? Because this low is higher than that one. Simple. This low is higher than that one. Simple. This low is higher than that one. Simple. This low is still higher than that one. I'm going to leave that one out because I'm going to put another thing there now. Then you have your higher high, higher low, lower high. So this is your first confirmation of a market structure shift or a change in direction, because this is going to be a change of character. So that's your lower high. That's another lower high, lower high, lower high. It's a bit messy, this is, but you get the gist. And if you look in the Porsche, it's all clear as day. Right, now let's get rid of this. Bang, 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 bang. Don't need it. Now, we have your breakage structure. Why is this a breakage structure and not a market structure shift? Because it's in continuation with this trend. Breakage structure, breakage structure, breakage structure. We don't get another breakage structure because after this high, we don't create another high. We create a lower high. What's that tell us? That tell us that price is changing character. That's your first sign of weakness of the trend, is your lower high in this scenario. That's your first sign of weakness in the trend. And then what can that tell us? If we get a change of character and we get a market structure shift, that tells us that the trend is that they're switching from bullish to bearish. So the trend that is swapping from bullish to bearish, but then our breakage structures now become here. Breakage structure, bang, broke past the low, came up, retraced, bang, broke past the low, and then same again. This would also be one down here. Bang, and then, for example, if we looked at this as a market structure shift, would this be a market structure shift? Well, we can see now this isn't because you can see it, but this would be a market structure shift. If you get a market structure shift after a change of character, it's always higher confluences. It's always a higher confluence that price may be changing direction. But now, what we have here is stop punt. Anybody selling with their stops above this high, they're all at the getting stopped out. So if you are selling from here and your stops are above here, and you're targeting whatever may have you, price came up, swept your high, stopped you out. Excuse me. Price came up, swept you out, and then went on its intended direction. Now, really quickly, I'm going to touch on it in a different. Sorry, I keep that there now for a second. I just want to take a little photo or something. That's essentially market structure. It's very simple. It's very easy to understand. Do you know what? We run through. I'm not running through all that there. We may as well just run through in actual. It's going to be a lengthy L video, I'll tell you that. Let's go daily. All right, let's identify a trend. What have you got here to start? We have price doing his thing, bobbling about in there. That's your consolidation range. And then once we break past this consolidation range, what does price do? It starts to make, so this is your consolidation range here, around there. And then what does price do? We break out and then we start making our higher highs and our higher lows. Higher highs, higher lows. Bang. Change of character. Market structure shift. Came down. Swept these lows. Went back in its intended direction. You can break down. The markets are fractal as well. I'm just going to leave it here because it's going to be a long video and I don't want you to get bored. The markets are fractal as well. So all that means is that whatever you see here, fair value gap, order block, liquidity levels, you'll see it on an hourly time frame. You'll see it on a 5-minute time frame. You'll see it on a 1-minute time frame. You'll see everything on the same time frame. It all moves the same. You can see here since market opened on the 1 minute jotting about, and then once we broke out, bang, swept, bang, gonna come down here now and sweep this and this and this. I would say that's market structure basics. You can see now that you can sort of try to link everything in together with your fair value gaps and your order block and your equilibrium and your market structure. And I'm going to do the liquidity video now. So you kind of be able to pull everything together, pull it all together, and then look at the chart. The best thing you can do, there's no point in you looking at me do this, and because I didn't even get the chance to run through proper examples. But look, there'll be plenty of time in the future for me to run through examples. But yeah, that's market structure. Run through, do a bit of homework. Don't just think you can watch the YouTube video while you're having a bit of grub and then you're brand new, because you'll know how to do it and you'll remember it forever, because it's not how it works. Take notes, get yourself a blue pen. Take notes. When you use blue pen to write down, it creates new neurological pathways in your brain and allows you to remember and understand stuff a million times better. So do it. Put the work in. Don't expect to watch the videos and just be a trader. Don't forget, if you're not trading, if you're not actively trading, whether it be demo, whether it be funded, whether it be live, whatever it may be, if you're not actively trading and you're not actively seeing how the markets move in real time, watching the YouTube videos, it's futile. It's nothing's going to work for me. But with that, we'll leave it with that for market structure, and we will get into the next video.